All right, folks, we're picking up where we left off on Monday because I was so loquacious at the beginning of class. You guys know that term, loquacious, garrulous, talkative. Yes. Big words that I like to use to make myself sound smarter. So when we left off, we were talking about confirmation procedures. And the last thing I told you all was each confirmation exception should be examined by the auditor to determine the reason for the difference. Now, this leads to an important thing that we need to discuss about what represents an actual exception versus just something that's not an exception. Now, there's a document that's I copied into the slides a little bit later. It's table 10-12 from the book. And one thing you will notice that each of the items of difference, it talks about some reasons for differences, but the reason at the top of every single one of these exceptions is called a timing difference. Now, I want you to make a note of this because this is really important for understanding. So the timing differences do not represent exceptions. Timing differences do not represent exceptions. They are exactly as they sound like. They're just basically an issue with timing. So just kind of a way to think about it for this particular course. Now, imagine that I've got the course set up on Brightspace and I've got an assignment that you don't have to submit anything for, but I've got to manually put the grade. But when the due date for the assignment comes up, it's basically a 0 in Brightspace, and you start panicking, saying, "I got 0 points for this assignment. I don't know what to do." And you email me, Dr. Barnes says, "Don't worry, I'll get around to it. I promise I will go ahead and get your points in." You didn't actually lose 10 points. It's just I have not put your grade into Brightspace at that point in time. That's effective equivalent of what has happened. So in the case of confirmations, we're talking about reaching out to a client's customer and saying, is the accounts receivable balance correct? And the accounts receivable balance could be correct or it could be incorrect. In a situation where it's not correct, we're trying to determine the reason. Now, for example, goods not received by the customers. Say the goods were delivered to the wrong customers. That's an exception. Okay. Our client is trying to claim that this customer owes them a certain amount of money, but they never delivered the goods to that customer. They're never going to collect that money from that customer because they delivered the goods to the wrong customer. That is an actual exception. But what if the goods are currently on the truck getting ready to deliver to the customer and the customer has just not received them yet? Is that an exception? Is that a problem? Not really, because basically they'll receive it at some point in time in the future. It will eventually be resolved, all other things remaining equal. That's how you think about a timing difference. Timing difference basically says is that this is a temporary issue that will be reconciled in the very near future. Now, it does not mean that a timing difference can't eventually result in exception. If the timing difference never gets resolved, like say somebody says the check is in the mail and the check never arrives in the mail, that certainly is a problem, okay? But if we assume that everything will be resolved correctly, a timing difference can be effectively answered by waiting a few days to say, did this get resolved? So the check is in the mail, wait 2 or 3 days for the mail to actually arrive where the check is in it. The check arrives, we say, all right, the customer was right. This timing difference did get resolved. So this is one thing I want to point out is when we talk about the differences here, these are all relatively self-explanatory, but the timing difference is one that needs a little bit of explanation, which is one of the reasons I included this slide on here. All right, so to wrap up, when auditors do not receive responses to positive confirmations, they should apply alternative procedures. Now, basically what this means is in confirmations, we have to determine if the amounts are correct. But if the customer of the client never replies to us, what do we do? Do we just say, well, they didn't reply, I guess we can't do any work. I guess we're just done. Just ignore that customer. It's not the way it works. When we we identify a customer through our sample testing, that is the customer that we're going to test. We don't just toss out a customer and select a new one. So what are some possibilities? Well, we're going to apply what's called alternative procedures. These are steps, evidence collection that are going to be less effective than if we actually receive the confirmations, but can still provide enough assurance. So one easy way, we can examine the subsequent cash receipts. So we reach out to a customer and say, do you owe the money to our client? And they never respond. 2-3 times we contact them, they never respond. But then we go and see that they sent a check in the mail to our client a few days ago. Is that an indication that they owed money to the client? Probably so, okay? So that would be a good way of obtaining assurance outside of doing through the confirmations. Another method, examination of shipping documents. We contact the customer, say, do you owe money? Did you receive inventory? And they don't respond. We say, all right, let's go ahead and see if there was actually anything shipped out to the client. And lo and behold, there was inventory that was shipped out to the client in the month of December. So we can say that's pretty strong evidence that they did receive inventory from our client, and so that's going to give us some evidence. That's obviously not as strong because it could have gone to a different party or the client could not have ordered it, but it does provide some evidence in that regard. And then basically examination of other client documentation. If there's any other client documentation that's been received, like a client purchase order or a customer purchase order, client sales order, the invoices, the shipping documents, whatever it might be that we can use to obtain assurance, any other documentation that might actually provide evidence as to this. Basically, alternate procedures are what we do when we don't have the option to complete confirmations due to whatever limitation we might experience. All right. And this is just a little gag up here as a confirmation how a bunch of prisoners light up. No, Stacy, you're thinking of conformation. Come on, guys, it's Wednesday. You got to work with me. Yeah. All right. It was a Monday that we're told a joke. Okay. Yeah. Dr. Otero and Dr. Caden didn't actually say this, but I could see them saying it. I mean, can we be honest? Yeah. All right. All right. Let's move on to purchasing. So purchasing is the same as the procurement process that we talked about in AIS. And what you're going to notice is you're going to see that this looks very similar to the format that we use for revenues. Now, first of all, that's intentional. And secondly, funny story is that when I first created these slides, when I first started teaching the course, I guess now we're looking at 9 years ago, I actually did use the same exact slides for revenue and just tried to change everything that said purchasing revenue to purchasing. Didn't work out well because I missed a few when I first started teaching the class. And so I was like saying, okay, I'm reading. I was like, a revenue process. I mean, purchasing process, ignore that. I think I've cleaned everything up, but it's taken me a while. So yeah, similar templates to what I use. These are actually the exact same slide template as before. So yeah. So one thing I wanted to talk about is we talked about the nature of fraud with respect to revenue process. And what do we say? Does fraud frequently occur with revenues? Yes. Okay. Now, does that mean it cannot occur elsewhere? And the answer is absolutely not. We know that fraud can occur in basically any income statement account. Some of them are very, very subtle. But purchasing is not one where we would assume that it would be a high level of occurrence. Well, there was a company called WorldCom. Okay, this is back to, they were a contemporary of Enron. They actually had an issue right around the same time as Enron. But basically, WorldCom was a telecom company, and they were a big provider of telecom and internet services right around the time of this whole fiasco going on in the early 2000s. And just for context, what a lot of companies had to do is that they owned a certain part of infrastructure geographically in the United States, but they sold services all over the United States. And so they would compete with one another, but when they sold in another person's region or company's region, they would have to come to an agreement. And the idea being is WorldCom had the region of, we'll say the WorldCom had the Northwest, all right? And they got a customer that was in the Southeast. Whoever the company that owned the infrastructure in the Southeast is, they would rent that infrastructure for that particular customer. That was called a line charge. Now, the rules around line charges were very, very explicit back in the early 2000s, is that line charges had to be expensed when occurred, or when incurred. That's not what WorldCom did. WorldCom capitalized these costs, saying that these were actually should be recognized as assets, and they should be expenses should be recognized over time, which is kind of how we would think about an asset like a piece of equipment, depreciating it over time. Now, think about what that does in the short term. If you say, I'm going to recognize an expense in the short term versus I'm going to recognize the cost of an asset, what happens to your income in the short term? So it goes up. It goes way up. By billions of dollars, it goes up, okay? Now, this is not a sustainable solution because you do have to recognize those expenses eventually, but they will get recognized over time as opposed to being recognized all at one point the way they should have been. That was what WorldCom was doing for several years, and everybody was saying, wow, this is a great company. All of a sudden, all of these expenses they were incurring started compiling, and everybody started wondering about their performance. Then some internal auditors went in, and they started trying to figure out what was going on, and keep in mind here that these are line charges were really, really small. No line charge was probably more than $1,000, and most of them were significantly below that. Multi-billion-dollar company, we talk about materiality. This is probably something that's so far beneath the notice of an auditor. If they notice an exception in a transaction, they said, oh, that transaction's probably not material, okay? It's unlikely it's going to be accepted for testing or identified for testing in the first place. And if it was an exception, it was a very small amount. So WorldCom was basically pulling the wool over their eyes. I believe Anderson was also their auditor, but I could be wrong about that. It's been so long since I've studied this in detail. But the internal auditors figured this out and they said, this is not right. These costs should be being expensed when occurred. And this is kind of one of the sad things is that everybody was really happy with their jobs at WorldCom and said, this is a great company. The internal auditors say, yeah, this company is perpetrating a massive financial statement fraudulent scheme. Guess who they blamed? Do you think they blamed the management of WorldCom? No, they blame the internal auditors who found the fraud scheme. They're saying, we had things going so well, then you had to basically ruin everything. It's like, well, the internal auditors didn't ruin everything. It was management that was ruining everything. Just uncovering it was what kind of where everything shambled. So that's an unfortunate side effect of that. But this is an example of how recognizing purchasing or recognizing purchasing can actually lead to some fraud concerns. So let's talk about some basic expense and liability recognition principles. Some things that you should already be familiar with, though may not be as intuitive as you might think. So purchase transactions usually involve the recognition of an expense and a corresponding liability, okay? Everybody agree to that? Let me move on. You all are just nodding your heads. You're not even paying attention to what I'm saying. Does that make any sense whatsoever? Not really, okay? Because you think about this, it's like, well, when I usually book an expense, I don't usually book a liability. How often does that happen? It does happen occasionally, but that doesn't happen. So what am I talking about here? What does this mean? And the answer is we have to dig a little bit deeper, okay? So let's think about a very simple scenario, then we're going to think about a more complex scenario. So simplification would be custodial services. So when you purchase custodial services, you have to recognize some sort of custodial expense, which is the debit, okay? And then you have to eventually pay those services, but probably not up front. So you recognize a credit to accounts payable, which is going to be a liability. So there's an example of an expense and a liability. And you're probably just nodding and saying, Dr. Barnes, when I was nodding my head, that's exactly what I was thinking. I was right on board with you right there, okay? That is a very rare scenario. That's a very, very rare scenario. Let's think about something that's a little bit more consistent so we can actually dig down a little bit deeper. Let's talk about the purchase of supplies, okay? Now, when you purchase supplies, okay, you probably recognize supplies as your asset, and then you recognize a credit to that accounts payable again, because you're going to recognize that liability, all right? Now, eventually the payable will be paid off. What will also happen to those assets is they get used over time. So what's that? They'll be credited, and what do we debit when we offset that credit? An expense, a supplies expense, because when we use up supplies, we say supplies expense, and we reduce our supplies actual asset account. This is an interesting philosophy in accounting, by the way. This is something that I was talking to my graduate students about, and I don't think that enough thought gets behind this. So this is not relevant to this discussion, but just kind of an interesting point. We consider expenses; those are expired costs. We consider assets. Could we categorize those as unexpired costs? Yeah, I think that's a very easy interpretation of it, because assets generally get transitioned to expenses. But for our purposes here, we did recognize a liability, and then we recognized subsequently as the asset got used up at a corresponding expense. So it's not intuitive, but that is what happens in the purchasing process. So most liability incurred in the purchasing process are trade accounts payable. Other items are accrued as liabilities at the end of each accounting period. So keep in mind, trade accounts payable is just our terminology is going to be accounts payable. Technically speaking, the term is trade accounts payable because we're talking about accounts payable as part of operations for short-term liabilities. But we generally use the vernacular accounts payable. All right, an auditor needs to understand basic matching and recognition concepts in order to audit the purchasing process. So let's talk about that. Let's talk about what's under statements of financial accounting concepts number 5. You all have that memorized, right? Yeah, you just memorized all the statements on financial accounting concepts? Yes, okay, you're nodding your heads again for me. That one is just, that one's just no because of sarcasm. So SFAC number 5 indicates that expenses can be classified in 3 categories, and these are ways that we think about the types of expenses. So expenses that can be matched directly with specific transactions and or events that are recognized upon recognition of revenue. So an easy way to think about these are product costs, okay? So what happens when we incur expenses as a part of manufacturing process? We recognize those as cost of inventory. When do we recognize the expense associated with the inventory? When the inventory is sold, okay? When we sell that inventory, remember we got that transaction, accounts receivables debited, credited, sales are credited, and then we debit cost of goods sold and we credit inventory. So That's an example of the matching principle in action with respect to this particular principle, is that we recognize it immediately as those revenue takes place. We recognize the corresponding revenue and the expense at the same time. We also have expenses that are recognized during the period which cash is spent or liabilities are incurred for goods and services. Such expenses cannot be directly related to specific transactions and are assumed to provide no future benefits. So in other words, we're talking about expenses that we can't match to revenues. So we don't have that matching principle that we can actually follow. But those expenses still exist. Those are kind of examples of period costs, is the easy way to think about those. So remember, period cost, those are items that we don't know that they provide any benefit. They just incurred. Like we talked about custodial services for the corporate headquarters. All right. That's not associated with production, so we can't assign that as overhead, but we still are going to incur that expense. So it has to be expensed when occurred. And then expenses that are allocated by systematic and rational procedures to the periods during which the related assets are expected to provide benefits. That's easy. That's depreciation, depletion, and amortization. So D&A. We know that expenses are going to be recognized over time as an asset is used up, but we don't use all of the asset at once. We don't use all of the asset at once, so it's systematic allocation of that. So important to remember those. Those are the kind of expenses that we can expect to see in this particular process. All right, as before, we're going to look at some basic category areas, just like from chapter 10. So let's talk about those. So 3 categories of purchase transactions. So we've got our purchasing transactions in the purchasing process. We got our purchase transaction, we've got our cash disbursement transaction, and we've got our purchase return transaction. That sounds really familiar. It's like we talked about that exact same thing 2 days ago, just flipped it. It's like the other side of the pancake, okay? That's exactly what's happening here, is that we're talking about now our client is the customer instead of our client being the vendor. Our client's the one who's buying. So what's involved in a purchase transaction? Well, obviously accounts payable. There's going to be usually inventory associated with that because they're purchasing goods, and usually goods, sometimes services. And then we could have the purchaser cost of goods sold if we don't recognize inventory immediately, if it's a periodic system. And then various asset and expense accounts. Usually the various asset and expense accounts only come up when we're talking about a manufacturing system. And that has to do with recognizing the cost of all costs associated with inventory, which would include labor and overhead. Cash disbursement transaction. Well, our client has to pay for their services. So that are goods and services. So what are they going to do? They're going to extend credit to the client, and the client will say, all right, 30 days are up. Here's your money. So they're going to disperse cash. They're going to eliminate the cash payable. That's when they would receive cash discounts as well. And then additional asset and expense accounts. Again, this is usually in a manufacturing environment where we would recognize cost associated inventory that we'd have to pay for cash. Good example would be like salaries payable. That would be an easy one that we'd have to pay in that one. And then purchase returns and transaction. This can be returns, allowances, accounts payable, and then those same expense and asset accounts. This is not going to be as much an area of focus for the same reason as what we talked about on Monday. Sales returns and allowances are generally not material. Purchase returns and allowances are not material. If they are material, that's when the auditor's got a problem. That's when the auditor has to say, why are these amounts so large? They should be an immaterial amount. So the same rule holds in this particular situation as it held for revenues. If we've got large amounts of returns and allowances, that's when we investigate. But otherwise, we generally do not bother ourselves because they're not considered to be a large priority. Documents and records, these should look fairly familiar because we actually did some testing of these back in chapter 6. So remember we talked about the voucher packages back in chapter 6, and we had to look for different documents that are part of the voucher. So the purchase request, the purchase order, we had to receive get the receiving report and the sales or the vendor invoice. There's some other documents that can be included in there, but these are all part of the voucher. And then basically these are going to be kind of supporting documents that are associated with that. But yeah, I think that's actually, if you are a little bit concerned about the purchasing process and trying to tickle the memory on that, you might want to go back to that activity back from chapter 6, because that's a good refresher on all the documents associated in the purchasing process. All right, major functions. I said that we were going to be looking at something similar to what we did revenue, so let's look at it again. So requisitioning, initiation, approval, request for goods and services by authorized individuals consistent with management criteria. So it's basically a request function. Usually it occurs at the departmental level. Purchasing is where we approve purchase orders, and proper execution is to price, quantity, quality, and vendor. Receiving is receipt of the authorized goods and services. Invoice processing is we process the vendor invoices for goods or services. Receiving also processing, adjusting allowances, discounts, and returns. Disbursements is going to be processing and payment to vendors. Accounts payable and general ledger, those are going to be our recording functions at the end of the process. Now I want to do the same task that we did for revenues. I want to say that the process is going to be a little bit less clean. All right. Keep in mind my disclaimer that I talked about on Monday. I said, even though we're going to be using the three segregation of duties, they don't always fall cleanly within every single function. But it's easier to think about them this way because it makes it easier to understand why we need to separate out responsibilities. Now, ignoring the fact that we actually have an approval step in requisitioning because the department itself has to approve the request for goods and services, requisitioning probably is going to be a recording function. This is where we actually record that request for whatever the goods and services are. At this point, it goes to purchasing, okay? And that's where the issuance of the purchase order is going to be taken contingent on approval by a supervising authority. So if it's an approval step, what is purchasing probably going to be? CARR. Authorization, A, okay? So authorization. Receiving, we're talking about receiving those goods and services, which assuming we're talking about goods are going to be an asset, which means we're talking about custody. That's being in the warehouse right there. Invoice processing. Now, this one's a really, really tricky one, okay? We talked about billing back in revenues. I said that this is a recording step, okay? Now, there is some recording that takes place, but it's fairly superficial recording. What do you think the invoice processing is more what their purpose is, what their function is? They're more reliant on. And the answer would be is that once the vendor invoice is received, they have to confirm that the information in the vendor invoice is correct, and if so, authorize it for payment. So rather than being a recording step the way it is in the revenue process, this is more of an authorization step. Now, again, I recognize this is not a clean partition. There are definitely some recording elements here, but for our purposes, we're going to think about this as more of an authorization step. Disbursements, what are we dispersing? We're dispersing cash. Cash is an asset. Therefore, this is going to be something of assets. Custody of assets, yes, custody of assets. And then accounts payable and general ledger, those are both recording functions. Again, they're redundant recording functions that occur at different levels in the organization. All right, so let's go ahead and do the same thing we did before. We got some segregation of duties, and let's talk about a few of these. So the purchasing function should be segregation from the requisitioning and receiving function. So if one individual is responsible for requisitioning, purchasing, and receiving functions, fictitious or unauthorized purchases can be made, which can result in the theft of goods and possibly payment for unauthorized purchases, which is generally not a good idea for most organizations to engage in those. All right, so let's talk about this. What did we say the purchasing function was? That's the step after there's been a request for goods or services, where we said there's approval, so that's going to be authorization, okay, authorization. Then requisitioning, we said in general, even though there's departmental approval that occurs in requisitioning, generally this is where we're recording the request. So this is going to be a recording function. And then receiving, that's where we actually have the assets in the warehouse. So that's going to be custody, okay? Custody, that's where we're actually looking at custody. So we're separating all three responsibilities out here. And what happens if we have somebody who's got responsible for all three areas? They can actually make a request. They can approve their own request. And then they can steal those goods from the warehouse, say that, no, we never received them. We don't know what happened to them. They went to my car. I mean, no, they definitely did not go into my car. Yeah. So yeah, that would be a concern in that area. Invoice processing function to be segregated from the accounts payable function. Okay, so invoice processing, accounts payable function, purchase transaction to be processed the wrong rights and terms, cash disbursed to be processed for goods or services not received, result for the overpayment of goods or services and theft of cash. So we know accounts payable is a recording function, but remember we specified invoice processing was more of an authorization function. So we're separating out responsibility for those two here. And disbursement function should be segregated from accounts payable function. Disbursement is going to be a custody step because it's cash. That's what we're dispersing. And accounts payable is a recording function. So we're separating those out. And then this last one right here, it says accounts payable should be segregated from the general ledger. This is just like that redundant function that we looked at back in revenues, where we said there are two recording functions here, but they occur at different levels of the organization. This is just to make sure that a misstatement does not get recorded at both levels. This is more of a redundant function than it is segregation of duties. But I won't focus on this. I won't ask you a question about this and say, is this segregation of duties? The answer is no, it's not really. It's not custody authorization recording, but it is still an interesting control. All right, inherent risk. So purchasing process, there's still inherent risks here. There's not as many as we saw in the revenue process because this is generally going to be a less concerning area with respect to risk. But what are some risk areas that we might be concerned about? Well, we're back to industry-related factors. Remember, we talked about industry-related factors in revenue. That was the BlackBerry and iPhone situation. If you have a big inventory of BlackBerries and all of a sudden the iPhone is released, you're going to be like, oh, yeah, I can't sell these goods anymore. That's a problem. All right. That's something we're going to be concerned about with revenues. What about from purchasing? Can purchasing industry-related factors? Here's an interesting one. If you go back a couple of years ago, did breakfast restaurants have problems with their goods acquisition? What's a really common breakfast ingredient that people tend to eat at restaurants? Eggs. What happened to the price of eggs 2 years ago? Yeah, it went way up. I think they tripled is what they were saying, okay? So the supply chain was definitely problematic at the time simply because of the way things were. If you're in the restaurant business, if you're like someplace that does mostly breakfasts, okay, because there are businesses that are like that, you're probably very concerned about the price of eggs goes up because that means that the prices of your meals go way up as well, since many of those are egg-based. So that could be affected by industry-related factors. Also, misstatements detected in prior audits. If there's misstatements that occur in purchasing, then that's going to increase the overall risk of purchasing for the client. So we're going to be very concerned about that. All right. We're back to control risk assessment. And sorry, guys, I have to apologize to you. We're still on a reliance strategy, okay? I promise the day is coming when we'll no longer be on reliance strategy, but we're still a few weeks away from that. For right now, we're on reliance strategy, which means we have to do what? We have to understand and test controls, okay? Going to be required there. Does that make sense? Intuitively, yes, because they're probably talking about thousands, if not millions of purchasing transactions that occur at a normal organization. So it doesn't make sense for us to try to test every single transaction. We do want to rely on clients' controls to some degree. So this diagram should look really familiar. It's the exact same diagram, just some different words in there, okay? Some different words in there. So again, we're going to be testing transactions and events assertions. That includes all assertions except for what? I did talk about this on Monday. Rights and obligations, yes, okay. So we're going to be concerned about what assertions are related to transactions and events, which goes to talk about that we need to understand the control sequence. Need to understand what the risk is and the associated management assertion, what's the control that's been implemented, and how do we test that control. So this is an important series of questions, an important series of steps that we're not going to go over in full detail of. So remember, back on Monday, I said there were two tables that you had to cover. First of these are controls over revenue transactions. Second of those were controls over cash receipts transactions. We got two more tables today, all right? We're 4 for 6 now, 4 for 6. So our tables now are going to cover purchase transactions and cash disbursement transactions. So let's talk about those. Here are some examples. Again, we're not going to go in detail, but you are responsible for that knowledge. So the first table is going to be table 11-6, page 394 in the textbook. So we're talking about assertions related to purchasing. Okay, back when we talked about revenues, what did I say for revenue transactions? Our most relevant assertion probably was, okay. So we said that it's a likelihood that organizations will record transactions that didn't actually take place. Do we still think that existence occurrence is the major concern when we talk about purchasing? Probably not. How many organizations are going to record purchasing transactions that never actually took place? That's just bad business sense. You don't want to do that, okay? So if we're concerned about that, we're probably going to flip side. We're going to be concerned about organizations that fail to record transactions that actually took place. What assertion do you think that probably is going to be? Completeness. Yeah, it's going to be our completeness assertion, all right? So that's exactly what I'm leaning to. What if a purchase was made but not recorded? Organization's going to be thrilled about that. So yes, don't have to recognize the liability, don't have to recognize the expense, okay? Still have to pay for it, but income statement's going to look good. You're going to have a whole bunch of expenses that never got recorded. And that's not going to be misleading to the customers at all, right? All right, so the stakeholders, I probably should say. Now we got to know that this is control, or this is a risk, so this has got to be there's got to be a control in place, all right? So what's a possible control that can be implemented? What if we have receiving reports matched to vendor invoices and entered in the purchase journal? So whenever the receiving report is going to be forwarded to the invoice processing department, whenever the invoice is received, we look at the receiving report and we make sure that the information that's in the invoice, the quantities that they're paying for, the quantities that the vendor is charging us for, are the same quantities that we received from the vendor. If those numbers don't match, is there a problem? Yeah, especially if they're saying, okay, we sold you 1,000 items. I said we only received 10. Okay, we're not paying for 1,000 of these inventory items if you only sent us 10 of those inventory items. That's a gross difference, obviously, but that's a pretty substantial illustration of it. So we want to make sure we match those and make sure those are correct. And then those numbers are entered in the purchaser's journal to make sure that those are get recorded for the exact amounts, the amounts that are in the receiving report. Okay. That's the control. How do we as auditors make sure that we're going to make sure that control works? So what's happening here? What's happening here? The receiving report information is moving up the stream to the vendor invoices. It's actually, we're taking this source document and we're going to put it or make it correspond to this source document right here. We seem to have a phrase for something when it moves up the stream, when we move one source document up to another part source document or moving into the system. What is that called? Move up. Tracing, yes. Okay, tracing a sample of receiving reports to the respective vendor invoices. And we can be more complete when we go to the vouchers. Now, what are the vouchers again? The vouchers are the packages of all documentation. So it can match into everything. We talked about this back in AIS, by the way. Remember we talked about the 3-way, 4-way match? I also talked about it on Monday. This is where we can match all the documents together for additional consistency, to additional purposes. That can be both a control and a test of controls. So we're going to trace that and make sure that what they say they're doing, they're actually doing. All right, everybody got that? Again, one example of many different examples that you will be responsible for understanding with come to the exam. But we're not done. We still have one more category. We've got cash disbursements transactions, which is the table number 4, okay, which is table 11-7 in the textbook. Now, cash disbursement transactions, let's go ahead and do existence occurrence for this one, okay? So what would be an example of this one? Well, we're dispersing the cash, but it never receives the customer. So we actually made the payment or just recorded the disbursement, but it never got paid, never got actually delivered to the customer, which is certainly problematic because I say customer, I mean vendor, my apologies. So the cash disbursement is supposed to be made to the vendor. They got recorded and then the vendor never received it. What's the vendor likely going to say to the client? Where's my money? And they say, where's my money? And so, oh, sorry, we'll send out money again. And so we're having to record multiple cash transactions. If you pay somebody $5 and they say, where's my $5? Are you going to pay them $5 again? Hopefully not. Hopefully you'll be, no, I paid you the money. Okay. But by the way, don't lie about that. You're supposed to be noble. You're supposed to be ethical accountants. Okay. So if you paid somebody, tell them that you paid them and be honest about it and don't pay them additional money. Okay. If you didn't pay them, pay the money. Okay. Because that's how we operate as accountants. Kind of stinks that you went to a profession where you have to be ethical, doesn't it? Yeah. Yeah. Oh, well, that's the burden that we bear. All right. So payments get made. We want to make sure all of our payments that are recorded actually get made. That's what we're trying to determine. How can we determine if that's the case? How did you all do that back in 302? What was your way to make sure the cash was correct? What was that mechanism that you used? Bank reconciliations, okay? Bank reconciliations are a control, okay? You guys were doing controls even before you knew what controls were. Isn't that great? Yeah, it's like I'm a control freak. Yeah. All right. Bank reconciliations, preparing and reviewing them. So we want to make sure they actually get developed, the reconciliations take place, and not only that, that somebody has oversight over those reconciliations to make sure that they get reviewed, to make sure they're accurate and that they get performed on a timely basis. This is, by the way, one of those ones in many organizations, especially smaller organizations, that goes overlooked. It's such a simple process, especially if you've actually taken 302. So it's a simple process, and yet many organizations don't do this in a timely manner or review the process effectively. This is one big reason why that fraud that we looked at with what's her face, Rita Crundwell, remember Dixon, Illinois? That was one big reason why she was able to get away with her fraud, is because nobody ever reviewed her reconciliations, and which probably makes sense. Like $5 million into my pocket, somebody reviewed that, they may say, hey, why are we paying Rita $5 million? Yeah, that would probably have been an interesting answer to that. So reconciliation period reviewed. How are we going to, as auditors, going to actually determine if that's taking place? So what would you do as an auditor here? You're the auditor saying, okay, they're performing reconciliations. I have to make sure those reconciliations are actually taking place. What are you going to do? Well, for starters, can we look at them? Yes. Our reconciliations accounting documentation? Yes, we can inspect records and documents, so we can review the monthly bank reconciliations for indications of independent review. So not only determine that the reconciliations are taking place, but if they're being reviewed on a timely basis, we should see evidence of that review on every single reconciliation. Very simple process, but that's an inspection of records and documents we talked about that provides us with that assurance, okay? Again, what was the goal here? The goal here is not to list out a whole bunch of independent thoughts, but to say, what is our risk, or what is our assertion? What is our risk? Does the control align to address this risk? And does our test align to test this control? This is primarily what I'll be looking for on the third exam. Not that you know this information, but that it makes intuitive sense, okay? Just like I said before, when I talked about this on Monday, if I say segregation of duties is a control, you can't tell me I'm going to observe or I'm going to test records and documents, okay? And I'm going to say what records and documents will test segregation of duties. And then you're going to be looking at me for a long period of time because you're not going to have an answer, okay? So make sure that you understand when you identify a control, what is an appropriate test of control? What is the appropriate evidence we can collect in that situation? It doesn't need to be precise. You don't need to memorize every single scenario, but you should have a good understanding of what makes sense in these situations. All right, as before, test of controls with purchase returns. There's not going to be a lot going on here. Usually, because this is such a small area, we can rely on substantive analytical procedures and some minimal protocol controls, okay? Making sure that only one individual has access to this area. Same rules apply for under the sales process, the revenues process, as they do here. Ultimately speaking, the biggest concern we're going to have is if these are material, why are they material? That's the first question an auditor would ask. So we're basically going to ignore this for purchase purposes moving forward. If there's going to be a question on this, it'll be a minimal question. It'll be something like, okay, what is purchase returns, what is our controls process for purchase returns allowances? And if I've asked you that question on the exam and I don't give you the answer, it's immaterial, you can write in the answer E, it's immaterial, okay? That's going to be the type of approach you can take to this. So now we're moving on to substantive testing. Remember, substantive testing, that's when we include all the rest of our assertions, okay? So we tested our our transactions and event assertions for test of controls. Now we include our account balance assertions because ultimately, what are we trying to get at? Are the financial statements correctly stated, properly stated? So we want to make sure those balances in the financial statements are accurate. Again, we can include test of controls and with our test of details. We can test transactions and events and account balances at this point. Usually if this happens, this is considered to be a dual purpose test, but ultimately we do have a different focus for the most part. We're trying to ultimately get to that end result that's in the financial statement. All right. So first of all, substantive analytic procedures, I gave you a little bit of a different document here because I could actually fit the table on this slide. The same basic guideline applies here as it did for sales. So when we talked about revenues, what did I say about substantive analytic procedures? I said that a model could be very, very helpful for trying to predict revenues. Didn't I say those exact words, guys? No, I did not say that at all. I was trying to see if you were paying attention, okay? I said that we cannot use revenue analytics very effectively because there's too many variables. So we generally are going to rely on ratios and trend analysis as indications for what we can investigate in the future. The same rule holds true for purchases. We can actually use ratio analysis and trend analysis. Modeling, reasonableness analysis generally will not come up. Does not mean it's not impossible, or it does not mean it's impossible. It just means that it's very unlikely that's going to happen. So usually the focus is going to be on ratios and trend analysis, and you can kind of see the examples here. Compare payables turnover to days outstanding accounts payable, previous years in the industry data. That's trend analysis, okay? Compare current year balances, accounts payable, and accruals with prior year balances, trend analysis. You can see where we're going. Sometimes they are used jointly because payables turnover, that's one of the ratios that we can calculate related to purchasing process. So we can actually look at trends in payable or trends in ratios over time. But for the most part, that's all you really need to remember with respect to substantive procedures in this area. What's really important are substantive tested details. All right. So for completeness is probably our most important assertion in this area, as we talked about before. So we want to make sure that all obligations have been properly recorded. We're going to have a very specific test for this called this search for unrecorded liabilities, which is one of your homework assignments, which I want to hopefully have time to talk about at the end of the class, because this is going to be something that's a little bit confusing if I don't otherwise. Then existent occurrence, not as critical assertion, but still one that we want to test. We want to make sure all recorded liabilities are valid obligations of the entity. So anything that's recorded as a liability, it's something that they should have to pay for, okay? That's not something that they get that's recorded and is erroneous. VAA, all accounts payable are recorded at their proper value. So when we talk about recording accounts payable, that we make sure that they're recorded at the correct amounts. Rights and obligations, accounts payable are obligations of the entity. Generally speaking, this is not as big an issue as accounts receivable because it's unlikely that you will factor or eliminate payables for whatever reason, but we still want to make sure that we're recording the proper obligations. Then we're going to talk about presentation. Presentation is all necessary disclosures of purchasing transactions, account balances have been made. Classification, these same rules, categories that we talked about for revenue are going to be here, but they're going to flip. So we're going to identify and reclassify any material credits included in accounts payable. Why? If they are material amounts, it's probably not proper to include them as a current asset. It's probably something larger. So we're probably talking about something like a note here, although it would be a short-term note. Again, separate short-term and long-term payables. Remember, we talked about this in revenue process, and I said, does the organization have an incentive to overstate their short or their current assets? And we said yes, okay, because that makes their liquidity position look better. To that same degree, can we affect liquidity by adjusting liabilities? Yes, if we reclassify current liabilities as long-term liabilities, what does that do to liquidity? Makes liquidity look better because liabilities are lower. So we're concerned about that same thing, although the opposite direction. We're making sure that they're not recategorizing current liabilities as long-term liabilities. And we ought to ensure that different types of payable are properly classified. Finally, all purchasing transactions and related accounts payable are recorded in the proper period. I think there's actually multiple cutoff tests in your homework, so this would be some examples of this. This is just basically trying to look at transactions that occurred before and after period end to make sure that they were recorded in the proper period. This is highly relevant for both revenues and purchasing as they can affect balances at period end. All right, let's talk about the search for unrecorded liabilities. This is something you're going to do for the homework. So this usually involves tracing payables to balances at year-end to year-end subsequent cash disbursements. Now, when I say the word tracing, I'm actually using that word correctly because this is a completeness test, and it's only a completeness test, but it's a very, very powerful one. So basically, what we're going to be doing is we're going to be looking at some information with respect to the vendors' account balances and subsequent period cash disbursements. So let's just think about this. Our client has a list of vendors that they owe money to. Okay, so we can imagine that there's a listing of that. In fact, there will be a listing of that for your homework. We can also look at subsequent cash payments to vendors that occurred immediately after the period end. Okay. So this is the January. So if we're year is December 31st, we're talking about like January, something like January 1st through the 5th. Okay. So for a few days after period end. Now, if we've got a vendor and they receive a check for the amount that they're owed, is that a problem? So a client pays a vendor for the exact amount that's owed. Are we as auditors going to say that's a problem? Not at all. We're going to say, oh, they're paying their vendor for the exact amount. Okay. That's scenario number one. Okay. Scenario number two. Now think about this before you answer. Let's say that they've got a vendor and they make a payment to that vendor for an amount less than what is owed to the vendor. Is that okay? Yeah, that'd be fine. Okay. That'd be fine because they're paying for a portion of what they owe, not the whole thing, but a portion of what they owe. Assuming that they owe different amounts that are due at different dates, paying a portion seems fine. All right. Here's where we start running into problems. Let's say they've got a vendor that's got a balance of $20,000 and the client pays them $50,000. Is that a problem? Yeah, why are you paying the vendor more than you owe them? Possible answer is that a payable or a transaction did not get recorded. Hence the reason it's called a search for unrecorded liabilities. Okay, there may be a liability that's actually being paid for but did not get recorded. So is that always the answer? No, but that's something that would raise suspicion. And this is where we would flag it and say, we want to investigate what's going on here. So payment is made for an amount greater than what the balance is. Final scenario. Let's say there's a payment to a vendor that has a $0 balance. Is that a problem? That's possibly a problem as well. That's one we'd want to investigate as well. Why are you making a payment to somebody you don't owe money to? So those are 4 possible scenarios, and you'll encounter all those scenarios in your homework assignment. Again, you have to delineate, do we need to investigate the possibility of unrecorded liability? And that usually means that there's a cash payment for an amount more than what is due to the vendor. So if the unrecorded liability might exist, we're going to examine the date of the receiving report and vendor invoice to determine the liability relates to the current audit period, and then review the files of unmatched purchase order, receiving reports, and vendor invoices for any unrecorded liabilities. The idea being here is that if the payment relates to something that occurred in the previous period, we're going to tell our client, you have to book this as a payable because you're making payment on a payable that occurred in the previous period. It has to be recognized as a liability in that period. It can't be shuffled off into a subsequent period. Now, keep in mind here, there could be a legitimate reason for it. Remember, we're talking about the first 5 days of the period. It could be for a transaction that occurred in the current year as opposed to the period under audit. So that's certainly a possibility, which means that doesn't mean that a liability actually took place or actually is unrecorded. It means that we're investigating the possibility that there's a liability that took place. And one of my favorite pictures of all time here, this is Jason Lynn, Dr. Lynn, who used to teach finance. And you guys recognize this clown right here, okay? But he used to actually, he wore, one time, he wore a purple suit to the bridge ceremony. And we were all just impressed by it. He got so much attention by it. I think he wore it one other time. He wore it 2 times, and he's scoured all pictures of him doing that, okay? But I found one, and it's never going away, okay? I've got it stored in multiple places. So if you're working with him and trying to scour it, trust me, you don't have all the images of me having this. I'm going to hold on to this forever, okay? But it's because it's a liability to him, but it's an asset to all of us, okay? It's an asset to the world. All right. Last thing to talk about. Let's talk about confirmations, because we can do confirmations for purchases as well. So we need to talk about what are the purchases for confirmations. Well, first of all, when we convert accounts payable, we generally are going to be focused on completeness. That's going to be our focus for that. That is not to say that we can't test other assertions. We definitely can test existence, valuation, and cutoff as part of confirmations. Oh, sorry, not cutoff. What did I say? Existence, confirmation, or it's existence, completeness, and rights and obligations. My apologies. Cutoff is testing only transactions and events. See, even I do it. Even I sometimes put confirmations as test of controls. My bad, guys. All right. So, but primarily focused on completeness. And usually when we're talking about payables, we're going to use a form of confirmation referred to as a blank or a zero balance confirmation. Now, there's there's a few reasons why this is used, but basically this is putting the onus on the person who's filling out the confirmation to provide the balance, which oftentimes this can be used in multiple scenarios. This can be used for revenue confirmations or for accounts receivable confirmation. But one of the big reasons is, let's say that we send a confirmation to a vendor and the vendor is owed $10,000, but we slip, or the client has slipped in their recording and they said the vendor is owed $100,000. And so the vendor receives this confirmation and it said, confirm whether or not you owe $100,000. And the vendor says, oh, wow, they're going to pay us an extra $90,000 if we say yes. All right. So yes, the client owed us $100,000. The confirmation is correct. So the client's mistake is basically never going to be flipped by the vendor's action. So in this particular scenario, by providing a zero balance confirmation, we enact vendor action to make sure that they're reporting honestly. And the same holds true for the reasons why occasionally when we're talking about receiving an organization, when they send out a purchase order to the receiving department, the purchase orders will not have quantities listed on that matching document, just because we want the people in receiving to look at the inventory and count the inventory amounts rather than just record what the number is on the purchase order. But the idea being is that if we don't record an amount, whoever's responsible for responding to this will have to record the amount, and they'll do so honestly. It's important to note that a zero balance confirmation is a positive confirmation, a form of positive confirmation. So we are always going to request a response in here. In most cases, we generally are going to require positive confirmations for purchasing, usually because they represent higher risks in that regard. That being said, it is possible to use a negative confirmation similar to the ones we used in revenue. It just doesn't occur as frequently in this process area. Also, important to keep in mind the thing that we talked about at the beginning of the class, the beginning of today's lecture, we talked about timing differences. Can timing differences exist for purchasing as well as they occurred for revenue? What do you guys think? Yes, they absolutely can. Anything that will be temporarily resolved as long as we wait a few days represents a timing difference. That could come up when we're issuing confirmations. Our solution to that problem, if we think it's a timing difference, we just wait and see if the problem eventually reconciles. If the answer is yes, then we don't recognize it as an exception. The only time an exception occurs is when there's a legitimate difference between what the client says happened and what actually happened. So it's important to keep that in mind. All right, we are done with chapters 10 and chapter 11. You've got homework for that on Friday, so I will see you all then.